All right. All right. Welcome, everybody. Welcome. Let's get started. All right, guys. So, welcome again. Bring the volume down just a little bit. Welcome. Thank you guys for tuning in. Today, we are going to go over Fibonacci, guys. We are going to go over Fibonacci. And Fibonacci, you're probably familiar with it. It's a tool that's used on TradingView, on other platforms as well, where the point of it is we're trying to pinpoint reversals, right? So a lot of the times in our strategies, what we're trying to look for is that perfect point of entry, right? When we're trying to enter a trade, what is that? How do I actually find that perfect point of entry? In other words, how do I improve my chances of having a sniper entry, right? That being said, in order to do that, you need to study different types of reversal patterns and reversal tools, right? That'll help you predict when that reversal is coming. And when we say reversal, it doesn't always necessarily mean an actual reversal, like a big reversal. It doesn't always mean like an actual reversal, such as, let me give you an example. From here on, we're on an uptrend, correct? And then that reversal on this chart right here, that reversal happened right over here. So when we say we're looking for when that reversal will happen, it's not just the classic textbook example of what a reversal is, right? But sometimes it's the reversal, meaning the retest, right? Because this is what I mean, and I want you to follow carefully. When we are on a trend, we are in a trending market, right? When we are in a trending market, there's what I want you to know. We are in a trending market, and I'm going to pick a specific part on the chart real quick so you can see what I'm talking about. All right? We are on a trending market. So let's say this is a downtrend right over here. This entire thing, starting from the reversal, is a downtrend, right? We can see that from here going all the way down. This is a downtrend, right? Now, being that I'm on a 1 hour time frame, on the 1 hour time frame, this is going to look like this particular area right over, give me a second, this particular area right over here is going downwards, right? We are on a downtrend, we're going downwards. But if we take a closer look at this area over here, right? This particular area over here, as we're in this move, let's take a closer look at what's going on, all right? And we're going to do a little bit of multiple time frame analysis here to really understand what's really going on. Okay, so we are going to study this entire area right over here. So we had a downtrend. Let's study this area during the retest. Going down to a lower time frame. Let me just see where we're at. 5th of December. Going down to like the 15-minute. Going back to that area. All right. Now, if you just focus on this area, on the 15-minute, this entire area, right, looks like an uptrend. This entire area on the 15-minute looks like an uptrend. And that's okay. That's what's supposed to happen, because when we do a multiple time frame analysis, a retest on a higher time frame, is going to look like a complete reversal on a lower time frame, right? So going back to the higher time frame, 4 hour, 1 hour, etc., right? Back to the 4 hour time frame. We got our move to the downside. This is just a retest. We're not saying there is a reversal. Why? Because we said, what are the rules of understanding the market? We said we have an impulsive move to the downside. We have a correction, right? And then we have a continuation, right? And then a correction and a continuation. And how do we know our corrections are valid? Well, if we're on a downtrend, we know they're valid because starting from here, this is the high starting from here, this is the high that was made, right? We come down, and then the next high of the retest does not pass the previous high. All right, the previous high is here. The next high, we have to make lower highs in order for this to be a valid retest. Okay, in order for it to be a valid retest, we got to keep making lower highs. And then over here in the point of interest, the point we're studying, we again made a lower high. All right, so all good, all valid. We're all good as far as it comes to the market structure over here. But now when we drop down to a lower time frame on the 15-minute and we use these same rules, let's go to a lower time frame real quick, right? Going to a lower time frame on the 15-minute. Let's keep those same rules, guys. Keep those same rules. All right, so on the 15-minute, what we are looking at, we had a move to the downside, big move to the downside, small correction, continuation, and then what happens here, right? What happens here? So what happens is here, the high of this got broken from the high of this, thereby causing this to start an uptrend. So in other words, the whole point of me telling you this, the whole point of me showing you this is to prove to you how a retest on the higher time frame is going to look like an uptrend on the lower time frame. Okay, and that goes hand in hand with our reversal patterns and our tools that we use to spot those reversals, because those tools can be used not only to spot reversals on a high time frame area, but those tools could also be used to spot reversals on a lower time frame area. Okay, so using Fibonacci, what we want to do is not only spot the major reversals on the higher time frame. So in other words, I don't only want to spot when this big drop is happening and the entire, all right, time alone. Thank you. I appreciate it. Thank you. All right. So when we have this happening, right, this whole reversal, when we have that break of that trend line, we are not just using our tools to measure the major reversal on a higher time frame. We're also using our tools to measure the reversals on a lower time frame. Another way of saying that, right? Another way of saying that, if you following what I'm saying, is we're not just measuring the higher time frame reversals. We are also able to measure the higher time frame retests. We're also able to measure the higher time frame retest to figure out the best point of entry within that retest, because all a high time frame retest is a low time frame reversal. That's all it is. Okay, I hope that made sense. If it didn't, definitely let me know, but I hope that made sense. Okay, so now let's start using that Fibonacci. Let's see how that comes into play when we are looking at a particular trend. Okay, so let's start with that same area. So you were previously on this uptrend. Again, you were previously on this uptrend over here. And then boom, we had this reversal happen. We had a reversal happen, but you're not just going to jump into your trade just like that, right? You're not going to just jump into it just like that. You need confirmation that this is indeed a reversal. So what I need to see is that this retest and the retest cannot pass the previous high, okay? So let's test this out. The previous high is right over here. All right. I got a request to repeat the correlation between higher time frame retests, lower time frame reversals. Gladly. Okay. So when we look at the higher time frame, when we are spotting reversals, first of all, how do I know that this particular area is a reversal, right? And let me highlight that. Let me go through that again one more time so everybody's clear on that. How do I know that this is a reversal? Well, because based on my rules, right, we said there are three main ways, four ways in all, three main ways the market moves: impulsively, correctively, and by continuation, right? So all of these rules are being obeyed for the most part over here. And what I need to see is, what I need to make sure on an uptrend is that the previous low is not being broken, right? So on an uptrend, as I have my continuation to the upside, I create a low. And then the next low that I make, I need to make sure that that low doesn't pass the previous low. If it doesn't, it qualifies as a valid retest. So we're good. We're still on this uptrend. It's still trending. Why? Because it's following the rules. The lows are not breaking on this uptrend. Okay. So now we get up here for the next continuation, right? We get up here for the next continuation, right? We get another retest, again, respecting the trend line right over here. But what happens right after that? Right after that, we get to this area, and then boom, we break the previous low. Not only do we break the previous low, but the two other previous lows before, we break that as well. So we can say, not confidently yet, but we can say that this is probably a reversal. The confirmation, let me just remove some of this. The confirmation that this is a reversal is that I need to see that when this is retesting, when this move creates its retest, in other words, this over here, when this move creates its retest, I want to make sure that the retest now doesn't pass the high, the previous high, okay? I know it's a little confusing, but on uptrends, retest, we want to make sure that we are making higher lows, all right? We want to make sure we're making higher lows again, higher low, higher low, higher low for uptrends. For downtrends, we want to make sure we're making lower highs, okay? We want to make sure we're making lower highs. That's how we test out our retest for downtrends. So over here, starting with the first high is over here, the next high is over here. We're good. That's a retest, a valid retest before it falls. Now, my question for you is now, how do we use a tool like Fibonacci to get into this trade at the best area possible? Because let's be for real, guys. One thing I'm not going to do, I'm not going to just give you some, like show you what could have been, acting as if like this is what you would have thought in the live environment, right? In the live environment, you're really not thinking this way. Like let's be for real. I'm going to use my replay tool if I can. All right. I'm on my free version. It's okay. But just imagine right over here, we cannot see the right side. So we don't necessarily know when this retest is ending so that we can enter and take our sniper entry, right? That's the challenge right now. So how can we use something like Fibonacci to, as well as our other knowledge on market structure, to be able to predict this reversal, okay? So let's start with Fibonacci and what that is first of all, okay? So the Fib retracement tool, and I'm going to draw it out here. This is what the Fib retracement tool is. Fibonacci in general, that was a person. He was a mathematician. And what he discovered is that in nature, there are certain set of numbers that appear consistently throughout nature. And you can find these set of numbers in multiple things, right? We're not going to go through all of those things, what those things are. But in many, many areas, in many, many places in nature, you can find these numbers, all right, mathematically. Now, we realized that we soon realized that you can even apply this concept to the charts, where these specific numbers end up being extremely significant on the charts when it comes to trading. Okay, so that being said, this is why we have these numbers here on the right hand side. And let me try to zoom in so you guys can actually see those numbers. All right, this is why we have these numbers here on the right hand side. Right, we have the 23.6, we have the 38.2%, the 50%, the 61.8, 78.6, 88.6, 100%, right? So on and so forth. Now, there's a particular number that we call the golden ratio, right? The golden ratio when it comes to the Fibonacci sequence. That particular number is the 61.8. That's the golden ratio, right? Reason being is that in this particular number, when it comes to trading, when it comes to the charts, it has shown over time to be very significant as a point of reversal for many trending markets, right? Or markets that were trending and eventually reverse. Okay, so what I want you to I want you to understand that as general knowledge, but what I don't want you to do, and this is the mistake a lot of people make when teaching this subject, what I don't want you to do is think that the only significant number on the Fibonacci sequence is 61.8. It is not the only significant number, because if you tell yourself that, if you do that, what's going to happen is, guys, you're going to only look for trades that hit the 61.8, and you're going to miss out on some trades, or you're going to wait till the 61.8 is hit, and the minute it's hit, you're going to enter your trade, and you're going to lose a lot of trades. All right, it's not the only important number. Now, when it shows itself to be important, I'll show you how we know that Fibonacci number is important at the moment. When it shows itself to be important, then great, add that as an extra confluence, but don't force a 61.8 entry. Okay, now let's go into, if you need any clarification on that, just let me know, guys. But if not, we're going to go into how to actually plot this actual tool on our chart so that we can actually use it. All right, and how do we use it? Okay, we're going to try to measure this area. So the goal, again, the goal is to predict the end of the retest. Okay, so what is our goal for today? Our goal for today, predict end of retest. Okay, that is our goal for today, right? And we have a second goal as well, right? Get the best entry, right? So we want to predict the end of the retest. That's number one. And we want to get the best entry. That's number two. And again, we're imagining that price came, it's reverse, it's retesting, right? And we know it's retesting. Clearly, we can see it's retesting, but we just don't know when the retest is over so that we can capitalize on this continuation to the downside. Okay, that's what we're measuring right now. So now, using the tool, this is how we're going to use it. Use your fib retracement. You can find it here. Okay, you can find it in this area, fib retracement. And what we're going to do is we're going to go from swing high to swing low, from swing high to swing low. What that means is, starting with this particular move, like, remember, we broke this move into different parts. The first part is the impulsive part. The second part is the corrective part. For the impulsive part of the move, we want to measure the high of that. Okay, so the high of the impulsive part of the move is up here, right here at the very top, right over here. Okay, that is the high. And then we're going to measure it from swing high to swing low, meaning we're going to measure it from the highest point of that move all the way to the lowest point of that move. So as I click on it here, it's already stuck on the highest point, and then I bring it all the way down here, and it's now at the lowest point of that move. Okay, I hope that makes sense. Okay, so plotting Fibonacci, plotting it at the highest point of that impulsive move to the lowest point. And obviously, you can only do this after you're already seeing that the market is starting to reverse. So the market can't be over here and you're trying to plant Fibonacci. It has to be clear that the market is reversing. All right. So if the market is reversing, and you're at this particular point, you clearly have confirmed that we are on a reversal right now. then and only then I'm comfortable starting to plot my Fibonacci points, because I know for sure now this is the high, that's a given, but I know that this has proven itself as the low now. This is now the low. Okay. The next thing I want to do is I want to extend that Fibonacci across. Okay. So I didn't do nothing to this. All I did was extend it across. Let me do it one more time for y'all so y'all can see. So from swing high to swing low. And the whole reason why I'm swinging it across is because I don't know why. I don't know when the retest is going to be finished. So I want to leave enough room so I could see where the numbers are being hit pretty much. All right. I want to leave enough room so I can see where the numbers are being hit. Okay. Now, again, what a lot of people do when using Fibonacci, they either are going to wait till this thing hits the 61.8 and they're going to take that trade, or if it doesn't hit that 61.8, they just miss out on the trade. This is what I want you to do. Forget the 61.8. It hits one of the key numbers. Fine. Whether it was the 61.8 or not, it hits one of the key numbers. Fine. I want you to enter this trade only if we start to form an area of resistance. All right? Only enter this trade if and only if we start to form an area of resistance, meaning we hit this area over here and started to reverse towards the downside, right? Now, when we come back into this area, all of a sudden we're not able to break past this area. So as I'm watching this happen in real time, right, in the live market condition, I'm going to start to draw this box and I'm going to extend this box. And as the candles are being developed, I'm like, okay, let me keep extending my box. Okay, it's really respecting this area. Let me keep extending my box. Okay. So as I'm seeing this, remember, this is a 4 hour. This move took a long time to happen. So even if you break this whole thing down on the lower time frame, let's go to the lower time frame real quick so we can break this down. And I want you to see the detail of what is actually going on here on the lower time frame. I want you to see the full detail real quick. Okay. Let's go down to like the 30-minute. All right. So now on the 30-minute, on the lower time frame, let's look at the full detail of what's going on here. So we clearly see. So again, guys, real quick, as we are on the lower time frame, this is the key thing here with multiple time frame analysis. You have to keep in mind, as far as the overall move on a higher time frame, this is a retest. Okay. This may look like something else to me right now. Like this legit looks like an uptrend, does it not? This is what we went over in the beginning. This looks like an uptrend, right? And that's fine because that's how it's supposed to look on a lower time frame, right? A reversal on a higher time frame, as far as a downtrend, is just an uptrend on a lower time frame. That's fine. Just keep in mind, don't get confused here. Don't be thinking buys all of a sudden just yet. All right. Remember, my purpose of going down to a lower time frame was seeing the details in that lower time frame for that higher time frame retest. Okay, don't forget. So as we got to this area, we rejected heavy. And then we got to this area again, guys, and we rejected really, really heavy. Okay. So now if I rejected twice very significantly as I got to this area, the same area, if I get to this area a third time, right? Again, I rejected, got to this area. Give me 1 second. Got to this area, rejected. Got to this area again, rejected. At the third time I get to this area, what do you think I'm going to do? Clearly, I know I have knowledge of market structure, right? I have knowledge of market structure, and clearly I'm going to know that on the higher time frame, I'm on a retest. I'm waiting for the continuation. I'm trying to see how far the retest is going to go. This is showing me that it has hit an area of resistance, confluence number 1, and it is showing me that that particular resistance happens to fall in line with one of our Fibonacci numbers, confluence number 2, and that Fibonacci number happens to be the golden ratio, confluence number 3. A lot of confluences here for me to be able to take an entry, a key entry, right? Before we get into the entry, let me just see if there's any questions. Explain the highest and lowest points again when drawing the fib points. Fine. So with the fib points, I want you to understand the fib points, because some people get confused now. Some people get confused and do this. Let me show you. With the fib points, what they do is they draw the point from here, like the highest point of the entire move, and then they try to drag it all the way to God knows where. But like you don't want to do that, because why? You want to, it's for catching a retest within a particular move, right? So if I'm going to draw a fib from up here, right, I want to draw it from swing high to swing low. So until this area, which is my swing low, price showed me that it came back up and formed a retest. Okay, that's where I'm going to draw my fib level if I'm drawing it from up here. And clearly, this was another entry as well, because we see that area of resistance was formed here. But fine, we're not going to count this, because this is the first time we saw that the market was reversing. As the market comes back again and retest this area, we are measuring this. And again, we want to measure it from swing high to swing low. So swing high of the move, of this particular move, is up here to the low of that same impulsive move down here. Then the other thing the only other thing I'm doing is swinging this across so that I can make sure I track and see where the move goes up to. Okay. So going back to this entire thing that's going on over here, going back to this entire thing. Now, if you guys were on my live for the past couple of weeks where we talked about sniper entries, all of this is good, right? All of this is good. Being able to spot this is good. What's even better is being able to go down to the lower time frame now, use all the knowledge you've accumulated here. All the knowledge you've accumulated, go down to a lower time frame and really take advantage of this. This is where you really, really take advantage of this, all right? So I know what's going on here, all right? Now, as I go down to a lower time frame, follow me here, guys. And again, ask questions if you are lost, because this could get a little deep. As we go to a lower time frame, let's go back to our spot first. Okay. As we go to a lower time frame, all right, now I want to start to find my best entry. We could even do this on the 15-minute as well to find an even lower time frame, right? But I'm seeing multiple areas of resistance. After that second hit, I want to enter the next time we hit this area. Okay. So if I'm taking my entry, over here. One second. Where are my entries again? Okay, short position. If I'm taking my entry right over here, once I hit this area, my stop loss, I'm going to put my stop loss above the area of resistance. I hope that makes sense. I'm putting my stop loss above the area of resistance. Okay, because why? Again, price has shown that it's not able to break this area. So in other words, my stop loss is here. So that is about 23.2 pips. Okay. And now my target, I'm going to look on the higher time frame to look and see what is a reasonable target. What I can do is look at the previous low where price found an area of supply, of demand, right? And I can just use that as a point of reference for my TP. So what I can say is, since price struggled to go lower past this area, I could use this particular area as my TP. So what I'll do is, going back to the 30-minute, I'm going to extend that price measurement, that entry measurement, all the way down to that area. Okay. So let me just make this a little wider and make it bigger. Okay. And let's make sure we fix it on the higher time frame. And we are going to take this all the way to this area right over here. So when we actually enter this trade, and we take this trade, guys, how many pips do we make off of this trade? This trade was 214 pips for a 23 pip stop loss. Now you tell me what's the ratio, what's the rate of return for that? What's the R for that? You guys tell me, what's the R for that? That's a 23.2 pip stop loss. And you made 214 pips. What is that? A 1 to what? Who has the answer to that? A 1 to what? My mathematicians are in here. Who has the answer to that? That's about, oh, that's just about maybe just short of like a 1 to 10. Like a 1 to 10. And to be honest, the move just started. This is just showing you, as you are realizing a new trend is starting, you catch it at the right moment. If you know market structure, right? And you just have knowledge of a simple tool like Fibonacci to write a 1 to 9, and you just have knowledge of a Fibonacci, right? And you can use that as a confluence. You don't have to have a crazy stop loss. And you can hold this for a sizable move. Like, it's very reasonable that you had your TP set over here. Why? Because you know you are on a downtrend. You know this continuation is coming, right? And it's only right that I put my TP the last time that I knew price, the last place where I knew price got to, right? So I put my TP over here. I get a very, very smooth move for 214 pips. Now, if you think about it, this move, if you're patient enough and if you're skilled enough, you catch this move and you're done for the week. Not many people will catch 214 pips for the week. And I guarantee you, if you could catch 200 pips for the week, if you could catch 100 pips for the week, you are good for the week. If you keep doing that, you're well on your way to becoming a very, very wealthy trader. Okay. But this is, again, like, this requires market structure. Notice I'm not just trusting Fibonacci, right? This lesson is about Fibonacci, how to use Fibonacci, but how to use Fibonacci is not relying all on Fibonacci, right? We have to rely on our knowledge on market structure. We need to know the market. Market structure is king. All of the multiple time frame analysis I did, support and resistance, you need that. Fibonacci is just the icing on the cake. All right. So now we continue, and this is how you really capitalize on the move here. You continue. So fine, the move came down and gave you all of this. So it's not done. It's not done. It's retesting again. Okay, so I'm let me just erase. So actually, let me keep this just so I could reference it again. All right, the move comes to this area, comes down all the way over here. Let me remove this so it's clear for you guys. Okay, so we get a continuation. Again, we get a continuation down here. And then what happens after that? We have a retest forming. We have a retest that is forming, guys. So as this retest over here is forming, I want to do the same exact thing that I did. Same exact thing, no different. Swing high to swing low with my Fibonacci. Okay, so swing high is going to be here. The high of this move is here. This is where this continuation started, right up here. And then this continuation ended right over here with that red candle. Ended right over here. Now I'm just going to drag this horizontally. All right. Just like that. Just like that. Now, again, what are we looking for? We're not just looking to see when a particular number gets hit and then we enter. That's not what we're looking to do. What we're looking to do is let's look for an area of resistance. On the downtrend, for the retest, let's look for an area of resistance. Let's do that. Okay. So now, as we go down to the lower time frame, let's look for the resistance on the lower time frame. Okay, lower time frame. As we go down to the lower time frame and we're looking for this resistance, let's look to see what happens. So this is the area. Okay, this is the area. All right. And this is what happens. Price goes up to this area, comes back down, and then all of a sudden, price struggles to get past this area. And then all of a sudden, same area, price struggles to get past it. So what am I starting to notice? I'm starting to notice that price is creating an area of resistance. And as a matter of fact, if I look at the first time it even visited that area, the bodies of the candle couldn't even get past this particular area. So this area seems to be very, very significant. I'm going to classify this area as an area of resistance. And the next time I see price hit this area, I'm going to enter. The very next time price hits this area is over here. I'm going to take my short position. And what am I going to do after I take my short position? I want to, give me 1 second, keep my stop loss above the area of resistance. Just because the wick went a little past this area too, I'm going to be fair, right? The wick went all the way up here. I'm going to be fair, and I'm going to make sure my stop loss is even above that. Okay, I'm going to make sure my stop loss is even above that, just in case there's a wick fill or whatever. Keep my stop loss above that. Okay, so fine. There's my stop loss. My TP, again, stop losses, you look for the stop losses on the lower time frame. TPs, you look for the TPs on the higher time frame. Okay, because you got to align with structure. It has to align with structure. Okay, so now as I'm looking for my TP, let me do the same thing. I'm keeping it consistent here. I did this right on the last play. I'm going to do the same thing on this play. I'm going to look for that previous area, that previous low, and I'm going to swing that across, right? The previous low was right here. Let me swing that across. Let me use that as a TP. I'll use that as my TP. Let me go back, extend that thing all the way down to that area of support. 1 second. I hope you guys see what I'm doing here. I'm going to extend this all the way down to my area of support, all the way down. And that's going to be my TP. All right. Why does it make sense to me? Because, again, price got to this area already. Price already got to this area, has shown me it can get to this area. That's going to be my TP. So what I love about this move, there was not even much struggle, and it didn't even take a lot of time. All right. This move was 129 pips, a 28 pip stop loss, 129 pip return. Okay, so you're talking about probably like a 1 to 5, maybe a little less, but this is what I'm talking about. You understand? So between this move, you probably catch this move the previous week, you catch this move the following week, all of a sudden you're starting to see yourself become very profitable, all from what? One move a week. One move a week, one trade a week. This is literally like, I was sold this, guys, when I first started my trading career, and to me it never made sense. I thought it was just BS. It never made sense. Like, you only need one move a week in order to really make money in the markets. That never made sense to me. But when you really start applying your knowledge in the markets, when you start learning about the markets, you realize, now, if you really know what you're doing, if you really know where you are in the market, if you understand technical analysis, you understand multiple time frame analysis, you know how to break things down, you know support and resistance, and you can just add little confluences like MACD, add little confluences like Fibonacci, all of a sudden, all I need to do is catch a monster move like this, and I'm done. I'm done. Because when I take my 100K account and I put in 3 lots, and I catch this whole 100 pip move, 129 pip move, I'm making well over $3,000 for that week on that one move. Trust and believe me, most people will not make that kind of money. All right. So that it's as simple as that, guys. All right. As simple as that when it comes to Fibonacci. And again, you keep doing this until the trend tells you I'm over. I already went through how the trend tells you it's over in the beginning, right? We know when a reversal happens. So far, if we go, let's go back to the 4 hour. So far, we've been respecting structure. So far, when we look at the retest, right, the first retest, this was the high, right? And this next high did not pass the previous high. So I'm still going to assume, no reason for me to assume there's a reversal happening here on a high time frame. There's no reason for me to assume that. Price action did not show me that. I'm going to keep on assuming we're still on a downtrend until I get that wrong. I hope that makes sense. So we're still on a downtrend. We are still on a downtrend. And the last example, I'll go through that last example with you guys on how we can capitalize on this. The last example, the very next one, 1 second. The last example, again, I'm going to do this one more time. Okay, so we said this ended here. So again, I'm going to, again, plot my Fibonacci from swing high to swing low. The high of this impulsive move was here. The low of it was right over here, okay? So now let me plot my Fibonacci one more time. swing high, 1 second, swing high to swing low, and then just extend it across. Extend it across. Keep that swing low though, but extend it across, right? Swing high, swing low, extend it across. What am I looking for? Somebody please tell me in the comment. What am I looking for? And then I'll definitely answer Boris the Butcher's question. What am I looking for, guys? I'm looking for an area of resistance, okay? So to get it, to really get it, to pinpoint it the best way possible, let me go down to a lower time frame. I'm going to go down to a lower time frame. And again, I'm going to look to see where that area of resistance is. Okay, fine. Price showed me it got to this area first, okay, and then gave me a major reversal off of that area. Fine. Price came back into this area, pretty similar area, and then came back down. Came back into this area, came back down. So I'm starting to see a pattern within this area. Within this area, again, I'm starting to see that price is rejecting. I'm starting to see that area of resistance that is forming this entire area right over here. Okay, so as price gets into this area again, I then want to take my entry. Okay, my entry over here could have been even over here, the previous one, but my entry over here, oops, my bad, that's Fibonacci. My entry over here, okay, my short right over here, and then again my stop loss just above that area of resistance, just above. Okay, you can make it extend it a little more if you want, but just above. And then again, I'm looking for my TP on a higher time frame. Look for my TP on the higher time frame. And my TP, let's be fair. We said we're going to keep that consistent, right? Even though it went further down, let's keep that consistent. I'm going to be fair. TP is at the swing low. That's the TP. Let's be fair, right? TP is at the swing low. And let's see what our return would have been. Okay. 1 second, guys. All right. And this is what our return would have been. And let me just note, we found our area of resistance, yes, right? For this move, we found our area of resistance, yes. But also note that that area of resistance coincided with the 61.8. Okay. Notice that it coincided with the 61.8. So many confluences here to be able to take this entry for the down move at this point. Okay. So we had a 15 pip stop loss. We had a 15 pip stop loss. Our TP is 100 pips, 99.4. 15 pip stop loss. Our TP is 100 pips again. All right. Again. So what is that? What is that? TP is 100 pips. Let me know what that is. That's a 1 to, that's close to 1 to 7, 1 to 6 point something maybe, right? I think so. Let me see. 1, 2. Yeah, I think so. Right, just short of a 1 to 7. So again, like this works, guys. This clearly works, right? But it's your knowledge of market structure. Boris the Butcher, what's your question? It's your knowledge of market structure, guys. This works. And I showed you multiple times how you incorporate this to take a sniper entry, and you catch that sniper entry. Not only do you keep your risk down, but you allow yourself to maximize on the profits. You allow yourself to make trading easy. That's the beautiful thing. When you use this and you put it all together with your knowledge of market structure, trading becomes easy. All right. So question, when drawing your swing highs and your swing lows, do you do it from the body of the candles or from the wicks? Awesome question, because that's the first question I had when I was learning this years ago, right? This is what I've heard and I've used, right? And it does work for me. For example, like there's a perfect example. For example, if you have such a big wick like this, right? If you have a very big wick, this is what I've been what I learned, right? Take it from half the wick, right? Because like here's the reasoning. Like the body of the candle, you have to understand, the body of the candle holds the volume, right? Sometimes with the wicks, it could be faulty because that could have been a news move, a news push, right? So price didn't really like establish itself at this level necessarily. It could have been a news wick, right? And it came back down. It doesn't mean it's completely insignificant, but we don't need to take the entire wick. So if I'm drawing Fibonacci in this area, I'm going to take half the wick because the wick is so big. I'm going to only take half the wick and I'm going to extend it across all the way down, just like that. All right. I'm going to only take half the wick and then extend it just like that. Okay. Now, the other point that I can make is technically, let's just be honest. Technically, it doesn't even matter which Fibonacci number it hits, right? Because what matters is where did the support form? Because again, I don't want you to go take away from this that the 61.8 is everything. And I see your question, Ty, right? Is 61.8 only good to get in on a reverse or at any time? So with the 61.8, right? It just happens to be that golden ratio, that number where the reversals will likely happen, right? But it doesn't mean it's the only number that reversals happen in. That is not the only number. There are way more numbers where reversals will happen. Okay. So, but the point is, it's not for me to focus on the numbers necessarily. That's what I want you guys to avoid. Don't worry about this. Don't worry about the numbers necessarily so much with Fibonacci. Use it as an extra confluence, yes, but don't use it as the main thing. The main thing is support and resistance, is market structure, right? What is the main thing? The main thing is, okay, I'm looking for the area, forget the 61.8. Where's the area of resistance being shown? It's being shown right over here. That's where the area of resistance is being shown. Then and only then, that's when I look at the number that coincides, if a number coincides with that area, and it just so happened, oh, that's the 50%. Cool. Let me just add it as a little confluence. It's at that 50%. It's one of those reversal areas. And then I'm going to take my entry based on market structure, okay? The core base of it is market structure. All of these things, Fibonacci, MACD, whatever, they're side. They're extra confluence. They're cherry on top. But the main thing, the foundation of what I'm looking at is the market structure. Does it work the same way on lower time frames too? Because I know that support and resistance are stronger on higher time frames than lower. Yes, absolutely yes, 100% yes. Fibonacci works on every time frame. But the thing is, there's still multiple time frame analysis that works here. So if I started with you guys at a 4-hour, right? And then I showed you how I broke it down all the way to the 30-minute. Let's say you're more of a scalper and you want to take some quicker moves. I can use the 30-minute as a high, quote unquote, time frame. I can use the 30-minute. Give me 1 second. I can use the 30-minute as a high time frame. 1 sec. Okay. Let me try to find a fair area for you guys. Okay. I can use the 30-minute, right, as a particular time frame, right, as a time frame of reference, right? And then I can break things down to like the 15-minute, even the 5-minute, just to show, to answer your question, Boris the Butcher, on can you use this on a lower time frame? So what I'm going to start from this point over here, right? Just to show you real quick. I'm going to go through it real quick because I know time is running and I don't want to bore you guys. But look, from this, I have an uptrend, right? A move to the upside, short move to the upside. I have price that is starting to retest over here. Price is starting to retest over here. Okay, let me just extend this. We have a move to the upside. Price is starting to retest. Now, as I go down to a lower time frame, what I want to do is, remember, for the downtrend examples, what I was looking for was resistance. For the uptrend examples, I'm on an uptrend now. What am I looking for in the reversal? What am I looking for in the reversal? I'm looking for support. All right, I'm looking for support. So let me draw my swing high to swing low. Let me make it clear. We said that the low is here. It went as far high as here before it started retesting. I'm going to draw my swing high to swing low from here. I'm so sorry. My swing low to swing high. I'm going to draw my swing low to swing high. All right. When we're talking about a downtrend, swing high to swing low. When we're talking about an uptrend, swing low to swing high. Okay, my bad with that mistake. Downtrend, swing high to swing low. That's how we plot Fibonacci. Uptrend, swing low to swing high. That's how we plot Fibonacci. Okay, just keep that as a rule of thumb. Okay, so we're on an uptrend. I'm going to plot from swing low to swing high. Extend that across. Okay, swing low to swing high. Extend that across. And again, just to show you the differences, on the downtrends, I was looking for, well, where am I forming an area of resistance, right? Where does the retest show me is not going past this area? For the uptrends, I need to see where am I forming an area of support? Where's price showing me is not going past this floor? All right, understand that this is all market structure, guys. Understand that first, right? Don't just run into Fibonacci. You just waiting for 61.8. You're losing trades. You get on a losing streak and say Fibonacci don't work. No, it's all like you got to know market structure. That's king. You got to know market structure. So now let's go down, as I said before, to the 5 minute. I want to remember this area. Okay, this is around Tuesday, January 16th, I mean. So let's go to like a 5 minute, because let's go to a really low time frame. Hopefully it gives me all of that information. I don't know if it will, but let's see. Let me see. Can we get it? Can we get it? All right, beautiful. We got it. So now we go down to a 5 minute, right? We're looking for buys, but we need to see where a support has been formed. We need to see where has support been formed. So fine. As it started forming its correction or the retest, I see that price went as low as this area, right? Went as low as this area, but at the same time, the body was around this area, right? Fine. Then price gets to this area, right? Price gets to this area, price gets to this area, and price gets to this area. I'm starting to see a pattern. At the point I get here, just put yourself in a real-time live market environment. At the point that I get here, and then I see this, yet another rejection around this area, I'm starting to believe, I don't know exactly what point, but I know this entire area, this is an area where price is rejecting. This entire area, price is rejecting it because it's rejected it in this area. Let me just draw the area so you can see, right? From here all the way across, it's shown me as far as this area, it's rejected it here the first time, here the second time, here the third time, and yet a fourth time. It's come back to this area and rejected this area. You know what? The very next time price will show me that it comes back to this area, I'm going to take the entry. Or if I'm early enough, I might just take the entry right over here if I'm early enough. Okay? And this is a 5 minute. This is a 5 minute. So your stop loss, you could only imagine, is going to be so great. All right? So fine, I enter my trade over here the next time it hits this area, right over here. My stop loss is below the area of support. If I want to put it past that previous wick, just in case, I'll do that. Just to be fair, that previous wick came as far down as here. I'm going to put my stop loss a little lower than the wick, and my stop loss is all but 13.3 pips. 13.3 pips. And I'm going to extend this to where? Where do I want to extend this? I want to extend this to the area to, first of all, let me go to a higher time frame, go back to the 30 minute, and I want to extend this to the previous area of resistance. Okay. So price, do we have a previous reference point? So we don't have a previous reference point. So what I'm going to do, I'm going to zoom out. I'm going to try to pinpoint an area that served as resistance. This was a previous area of resistance. All I could do is take this, swing it all the way across, and see if this area could serve the possible area of TP. This is how I'm doing it. Live market environment. These are the things I'm thinking. Like, I'm looking for a TP. Where could my TP be? Okay, look, let me zoom out. Let me zoom out. Is there anything in the area showing me this is where price got to before it came down? Because that's where I should stop. That's where I should take my TP. All right. The previous area was here, came all the way across, brought this all the way across, and I said, you know what? I'm going to use that as my TP. Now let's measure. We said the stop loss was 13 pips. Ah man, I think I erased it, but it was right over here. 1 second. From right over here. All right. So we said the stop loss was 13 pips. That was the original stop loss. 13 pips. I'm gonna bring it back. 13 pips. All right. And then the TP is right here at this area that I brought all the way across, right? So that's my TP. So my TP, 21 pips. So remember, we went to a low time frame, and you are a scalper. So if you're asking, does Fibonacci work on a low time frame? The answer, as you can see, is yes. Obviously, the gain is going to be much lower, right? So you got 20 pips, but it's still a pretty good. It's a pretty good risk to reward. It's almost a 1 to 2, not too bad. And I'm sure you could have allowed this to keep going, right? It depends on you. It depends on how you trade, how you find your TP. You could have certainly allowed this to keep going and go. You started getting a retracement, right? Maybe you finally got a rejection over here, and you ended up closing the trade right over here, right? And then you get 55 pips. That could have happened too. But it all depends on how you trade. Right? But the point is, you can do this on a high frame, you can do this on a medium time frame, you can do it on a low time frame. The point is, you're still going to get a tight stop loss. If you know what you're doing and you know where you are with market structure, you're going to use Fibonacci as a confluence, and you're going to be able to capitalize on this trade over and over and over. My word of advice, though, Fibonacci is smoothest on trending markets. So that being said, use a pair that's usually trending. UJ trends nicely. Sometimes gold doesn't necessarily trend as nicely. So it could be a little funky if you're trying to do this on gold. But if you're doing this on UJ, it trends very nicely, right? So maybe EU, maybe trends very nicely. So those things you got to keep in mind, all right? Yep. Absolutely. So for scalpers, swing traders, this works for it all, guys. So I hope you guys really understand the benefit of using Fibonacci, guys. I really hope I didn't confuse you guys, but I hope I brought clarity. If anything, you could always watch this again. It will still be on my YouTube. But guys, powerful tool. Let's really get back to understanding market structure, okay? Nobody's saying anything is wrong with indicators. Nobody's saying anything is wrong with tools. But they can't be your primary source of your foundation. They can't be what you rely on, right? Because that means you don't really understand the market. You need to understand market structure. Once you understand market structure, everything else is just gravy. Do whatever you want, whatever you like. You like MACD, you like RSI, you like stochastic, you like Bollinger Bands. Have at it. But market structure, you ain't got no choice. You got to know it. All right? I appreciate all of you guys. Until next time, until next week, guys. Peace and happy trading, y'all. Appreciate y'all. Take care.